Hello, dark traders. Welcome to Darkwave Trading. And as always, my name is Dark Saints. And I always begin by asking you a very simple question, which is, why are you here? Why are you doing this? Hoping that you have the right reasons. All right. And then after that, I normally proceed to show you this beautiful disclaimer right here, and to ask you to take your time and go through it. Please read through it. I always say that every time. So yesterday we are going through part one of forex trading terminologies, and today I would like to proceed to execution terminologies. Right, execution terminologies, and the first execution terminology we want to learn is scalping. Scalping is a trading strategy that aims to make small profits from very small price movements. And as I've taught you, we measure price movement in pips, right? That is where we stopped yesterday. Scalpers typically hold their position for a very short time, often just a few seconds or minutes. And if they hold their positions for a short period of time, then that means price is only capable of going a certain range of pips in a certain amount of time. So for scalpers, for them to make something tangible from forex, that simply means their risk is normally kinda high. Okay, it has to be high because you're trying to get in and out very fast. All right, you're trying to get in and out very fast, so the risk is normally a little bit high. These are the people that choose 10 lots. I'm going to explain about lots later. 20 lots, all right, with a very tight SL, a tight SL. I'm going to talk about stop loss. SL is stop loss too. Don't worry, I have you covered. Day trading simply involves opening and closing position within the same trading day. See, the only thing that differentiates scalpers, day traders, and swing traders is time. See, the traders do not hold positions overnight. Scalpers do not hold their position for hours, but day traders do. Swing traders, they involve holding their positions for a few days to weeks, taking advantages of swings in the market. You see, the difference between the three of them is how long someone holds their position. And for me, a day trader. Okay, so let's go over long and short positions in forex. Going long in forex simply means buying a currency pair with an expectation that its value will increase. So if I buy GBP USD or Euro USD, I'm anticipating, or my sentiment is that the market is going to go higher, and from that I'm going to again explain how that works at some point in a way that you're going to understand because most people don't. And going short simply means selling a currency pair with the expectation that its value will decrease. After that, stop loss order, I'll have to explain this with diagrams. A stop loss order is a predetermined price at which a trader will exit a losing trade to limit potential losses. Yes, you can risk $50 in forex, and once you risk $50, there is a certain way where we set some parameters to ensure that when you immediately at the point where you're losing $50, you get out of the market. It is a stop loss. It stops your loss, right, limiting potential further losses, right? Because without a stop loss, that is how many people lose their account. You just hope and pray that the market is going to go towards your direction, and that doesn't happen every time. Okay, we're playing with the probabilities here, so you might want to have a stop loss. Another thing is a take profit order. A take profit order is a predetermined price at which a trader will exit a winning trade to lock in profits. All right, you might be having $1,000 floating. All right, they're floating, you have not yet closed that position, but trust me, if the market reverses, you might end up having a loss or $0 in your account, yet you are up by $1,000. To stop something like that, we normally have a target. For example, a target goes like this: if I risk $1,000, I'm going to have a stop loss, and that stop loss is going to take me out of the market once I've lost $1,000, right? And then I'm also going to have a take profit, which is multiplied by your risk reward. So if typically most of the time, or averagely, our risk reward is normally 1 to 3. So if I'm risking $1,000, I'm expecting $3,000, right? Because I have an RR of 1:3. That's a realistic RR. Once I get to $3,000 in profit, I want to get out of the market and lock in those profits. That's why you need to have a take profit order. And I can simply show you that to you right about now, because I think I'm in a trade right now. So you see, I'm in a trade right now. I did my analysis and I was thinking that the market is going to go higher. And once I was thinking like that, when you think the market is going to go higher, you buy. So I bought Euro USD, right? After I did that, you see, once you double click on this tool, this is called a long position tool. You can see a long position tool. This was my entry price and this is my take profit price. Once you get to this point, I'm going to exit the market, and you can see it also shows my RR. So I've risked 1 to get 3.64, and you can see my stop loss here 1.07, which is this price. If I make losses up to this price, I'm going to exit the market. If I make profits up to this price, I'm going to exit the market. That is about the long position. The short position is basically the opposite. For example, you can have a short position somewhere like here. I know a lot of people captured this trade, right? For example, like that. This is a short position. You're anticipating that the market is going to go towards that direction, right? So you have your stop loss here, you have your entry price here, and you have your take profit price here, right? So if you risk $1,000 here, you see your RR is 3.25. If it all goes well, you're going to have $3,250, right? And you exit the market. Even if it's going to, you might want to make sure you're not greedy or anything like that to avoid. You see, even if you're profitable, that doesn't necessarily mean you're going to hit TP. That is why it's essential, it's crucial to have these parameters at play. Let me get back to what I was saying. I hope we're going to go, I'm just trying to explain about the terminologies, but we're going to go over them in a way that you're going to understand. So when we're discussing about execution, we'll get to that. We're going to get into more details about this one. So the bid and the ask price. The bid is the price at which a trader can sell a currency pair, and the ask price is the price at which a trader can buy the currency pair, right? And the difference between the bid and the ask price is known as the spread. And okay, this is it. Let me show you from my TradingView account here. See, this is my watch list. I told you this, guys, this is my watch list. Let me show you. Let's have this one, right? Yes. Is that going to give you, okay, is that going to give me what I'm looking for? I'm looking for something. It is not that visible here, but let me use another example, right? Let's just do this, all right? It's going to be a little bit hard for me to explain about the spread here because TradingView doesn't show me the spreads the way I want them to. I think I'm going to want to explain that later. The difference between the bid and the ask price, that is, I have a whole topic on spread, so don't worry, I'm going to explain this to you later in a way that you're going to understand. Now, let's talk about the lot size. All right, the lot size, a lot is a standard unit used or unit size of a transaction. Do you know how you guys say, I need a dozen of eggs, right? Saying you need a dozen of eggs, anybody who knows what a dozen of eggs is, they know that is 12 eggs. Are we together? Now, a lot is a unit size of transaction which represents 100,000 units of a certain currency. For example, if I want to buy GBP USD and I say I want to buy one lot of GBP USD, what that simply means is that I want to buy 100,000 units of the British pound. Are we together? I want to buy 100,000 units of the British pound, and I'm going to benefit when the price has changed. I hope we are clear about that. Now because I have told you about the long position and the short position, stop loss and take profit order, now and lot size. These are execution terminologies. Now, after now what simply happens is, now that you know your risk, okay, for example, I'm risking $1,000 and I am risking $1,000. Okay, let me use this example of the trade I have here. You see, if I'm risking $1,000 here, my $1,000 is going to disappear after price gets to this point. All right, and from here to here you can see it's 6 pips, right? So after 6 pips I'm going to lose $1,000, right? So for me to be able to know the amount of units I'm going to buy, you normally use a position size calculator to tell you the lot that you're going to execute, right? You're going to execute a certain lot which is going to ensure that after 6 pips you have lost $1,000. That lot size is going to ensure after 22 pips, now you won't be $1,000, but you'd be having $3,640. That is how we use a lot. Now it's very hard to to do these calculations. That's why I normally have a position size calculator. You specify. So for example, if I was risking 1% of my account, right? And my account is $10,000, and my stop loss you've seen is 6 pips, right? This is going to help me calculate the lots, right? This means I'll execute a lot of 1.667 at the entry price. And once I do that, that simply means the units that I'm trading here is, because one standard lot equals to 100,000 units. You multiply, you get 166,666 units of euro. All right. It's hard, but after some time you're going to have your grasp on everything, and everything is going to be better and easier. After that, slippage. I talked about slippage occurs when actual execution price of a trade differs from expect. We're going to learn these things. Whipsaw occurs when the market quickly reverses direction after trader has entered a position, resulting into a loss. Just know that for now. Then we're going to go to account terminologies, or should I get to account terminologies and finish this thing? Let me just go over account terminologies. It takes time. Okay. Account terminologies, we have demo trading accounts and we have live trading accounts. I've ever seen somebody selling another trader a demo account. I was seriously shocked. All right. So I want you to understand a demo account is a practice or a simulation account. It's a virtual trading account provided by brokers with virtual money. The money in a demo account is not real. Get that in your head, please. All right. It just simulates market conditions, allows you to try practice trading without risking real money. So you cannot withdraw, neither can you deposit to a demo account. Please understand that. Take it. And then a live trading account, this is where you have your actual money. You take actual risks and you get actual rewards. All right. And if you fuck up, you lose your account. That happens. Then there's something called leverage. We're going to discuss about leverage when we get to Forex mathematics. So chill. Leverage allows traders to control a large position size with a relatively small amount of capital. All right. It amplifies both profits and losses. Leverage can work in your favor or against you. Margin is the amount of money required to open a leveraged position. There's something called a required margin. You cannot execute one lot in GBP USD. I've said about lot. When you have $10, that is not possible, right? Required margin is like an initial deposit, like the least amount of money you need to have to do something, right? Sometimes I've had in okay, let me not try to explain it further, but that is that. Margin level is the ratio of equity to margin, and it's calculated by dividing your equity by used margin and multiplying by 100. All of these things we're going to go through them when we are discussing about Forex mathematics. Margin call occurs when a trader balance falls below the required margin level and they must either deposit more funds or close out positions to meet margin requirements. I've ever had a margin call when I was starting out, and if you're starting out and you do the wrong things in a live account, you're going to get a couple of margin calls, right? They are telling you, the broker is telling you to add more money, but don't even think about doing that because there's a high probability you're going to lose them. So margin call, that is margin call. Drawdown is the reduction of a trading account's equity from a peak to a trough. It's the measure of the decline in value of a trading account. And equity is the current value of a trading account, including open trades, that is your balance plus or minus your floating profits or losses. Liquidity provider is a financial institution or individual that acts as a market maker by providing buy and sell quotes for currency pair. ECN, electronic communication network, type of broker that allows direct trading between market participants. It provides a platform where buyers can and sellers can interact. Risk management terminologies. Risk represents potential loss that a trader will face when entering a trade, and you have that there. You can go through that. Reward in Forex refers to the potential profits that a trader can achieve from a successful trade. Risk reward ratio, I've shown you that, is a relationship between the potential profit and potential losses of a trader. Traders often aim for a positive. You don't want to have a negative risk reward ratio. Position size calculation. You've seen me do a position size calculation here and there. It involves determining the number of currency units or lots. We've talked about lots and units to trade in a Forex position to ensure that you've lost a certain amount of money or gained a certain amount of money that you have predetermined or decided. And that, my friends, that is all about Forex terminologies. The other ones, we're going to interact with them later on. And I hope you're enjoying yourself, and I hope I'm not confusing you any further. And if I'm confusing you, you just have the questions for me. I'll be glad to answer them to you. I just want to make sure all of us have a grasp of what you're doing. All right. Don't be that naive or stupid doing something that you don't really know. So that is it for today. I'm done.